We're going to try and get you an external view of what's going on with the rupee in the light of this very unprecedented mandate given to Narendra Modi. And joining us to do that is Sebastian Galli, Senior Currency Strategist at Societe Generale. Sebastian, thank you very much for joining us. How are the international currency markets looking at the political events here in India, the unprecedented mandate that Mr. Modi and his right-wing party BJP has gotten?
Hello, thank you for having me. It's a very, very significant event, which is very profound effects on the medium-term outlook for India. If you want to look at the global emerging market picture, of which maybe India could be part of, you've seen basically severe disappointments in several markets. Some of the weaker ones, such as Russia, some of the ones which were favorites, such as Brazil, and China, of course, has performed very well for a while, and in this now somewhat heading in a different direction. But India has been the one which has disappointed the markets for a very long time, and we're seeing this seismic shift. And so if we do get basically the reforms that the market is hoping for, these fundamental reforms, inflation fading lower, an improvement in the current account, more restrained side in terms of fiscal spending, and generally a positive change in terms of the outlook for the Indian economy, then it changes absolutely everything from a medium-term perspective. From an FX perspective, a lot of the potential rise in the INR and the Indian rupee has already been priced into the market. The central bank is suspected of being very, very aggressive in absorbing portfolio inflows into India. Foreign reserves in India have exploded higher, which is probably the smart thing to do. You don't want to choke the recovery or the potential for a further recovery in the Indian economy, and that means that the INR still has a bit of an upward path, but not that much. We expect it to basically end the year at 57.50. A lot of it is going to be transferred. These gains in FX are going to be transferred in gains in assets, a little bit in equities, a lot of it in bonds. The bond market in India specifically, if the reforms go through, is extremely attractive. The yields are very, very high, and if inflation does fade lower, then it will offer very strong, high real yield.
Fair enough. You said 57.50, if I heard you correctly, Sebastian. That's your expected level for the rupee by the end of this year?
Yes, it's not as much as you would expect. A lot of it is because people are waiting to see if these reforms are going to happen.
Right.
Exactly. So we probably have to wait for a few months to have a lot of clarity, where this is typically when you do the hard job, basically, of the reform and push through. Then the market will figure out and reassess. Meanwhile, what's happening is the central bank is simply going to cap the INR in as much as it can, and which is a smart strategy. And that means the potential gains are actually relatively moderate over the next few months. However, over the next few years, it's a completely different story. India could turn into what Brazil used to be.
All right. You preempted some part of my question when you referred to the central bank buying up dollars at this point in time. I was just curious whether 57.50 was a level that you expect without further aggressive central bank purchases of the dollar. So can you give me just a little bit more detail on what grounds that 57.50 is based on? Like, exactly what kind of reforms do you think will take the rupee there? What might disappoint currency markets and therefore hurt the rupee? Have you worked that out? How did you arrive at 57.50?
Sure. I mean, 57.50 is just an expectation of a slow grind higher in the rupee. When the main reason behind it being the very, very aggressive intervention by the central bank, which is the right thing to do. The reserves can increase significantly in India without it being much of a trouble. The main problem, if you're a foreign reserve manager, is you need to finance your reserve. It costs you money because, of course, you have to issue some liabilities domestically. It does not matter a lot if basically growth picks up. And what it means is you're basically making money by printing money locally. So any losses that you make in your foreign reserves is really no issue whatsoever if the reforms go through. If the reforms do not go through, as expected by the market, then we will get a significant disappointment, knowing that India has of course some issues on the current account to GDP ratios. So that's basically I think the main criteria most people will be looking at. A lot of the profits have been done by foreign investors investing in local equities. I think that is basically a good chunk of it is already done, and the market is trying to reassess if these reforms will help the earnings to pick up from relatively subdued levels, and if the market can pick up yields in equities in the next few years, because there is a significant reform going through in the system, more investments, and a more normal economy. that will attract, again, very significant inflows into the equity market. But a lot of it's already been done. We're more in a phase of consolidation at this point in time. Nonetheless, in the fixed income remains very appealing.
So what you're telling me is that you think that the bulk of the inflows expected into India's equity markets, foreign institutional flows, are already in. It's probably the debt markets that you expect to see, more inflows in if there is a turn or an evident turn in the interest rate cycle, so to speak, and that your 6-month target is 57.50. Your 12-month target might be more aggressive on the upside?
Of course. I think the longer the target, if conditional on the reforms happening in the next few months, the more aggressive
if
people
the reforms dream is fulfilled to that extent, yes.
Yes, and if you look at long-term valuation, INRs is actually a very cheap currency. So many currencies in emerging markets remain very expensive, particularly in other parts of Asia. INR is not from a long-term perspective, which is another way to say that India has not yet fulfilled its potential, and there's maybe the possibility that now that it actually will, and that makes it a very attractive long-term investment.
All right, there are negatives to that as well in terms of what it means for our exports, but then it means good things for our oil bill. I have a quick last question for you, Sebastian. You know, all of this is benchmarked to what goes on with the dollar as well. And just a short while ago, we had comments come in from one of the Fed officials, Charles Plosser, saying that he expects interest rates in the U.S. to move up sooner rather than later. What are you factoring in this 57.50 level and maybe a more aggressive level to the upside for the rupee? What are you factoring in terms of interest rate movement in the U.S. and therefore where the dollar will likely be?
Not much. So when it has to be very careful, the reason why emerging markets came under severe pressure last year was a problem of mainly positioning and the way the market trades. The market trades emerging market curves in a correlated fashion with the U.S. Treasury curve. As they did so, and their positioning was incorrect in emerging markets, that created very severe outflows out of emerging markets. Going forwards, the hedging has changed. The correlation between the two markets has essentially died down, and it doesn't make much of a difference for India if the U.S. Treasury curve is 50 or 100 basis points different from where it is. The Indian curve is massively higher, around 9%. It's a very little impact on that side. There are very few places where you can safely pick up yield globally, and the market, when it sees an improvement in the safety of one of these assets, typically will reward this very greatly, hence the significant inflows that we saw in India in the past few months. So if the Fed changes policy, it might have an impact on global equity markets, therefore will hit the Sensex to some extent, but it won't have the mechanical effect that we saw in fixed income in the past. That was really a one-off event. Very poor positioning by many people in the market, not all of them, by the way, and I think that's not necessarily something that will repeat itself.
Well, clearly you got saved of the worst of it, or at least that's what it sounds like from what you're saying to me on the phone. All right. Sebastian, thank you so much for that insight. We'll come back and revisit some of these targets that you've spoken of in a few months from now when we have a clearer idea of what this new government will likely do. Thanks very much for your time. That's Sebastian Gyali there.